Government borrowing in August reached £18 billion, the highest level for the month in 5 years, putting enormous pressure on Chancellor Rachel Reeves ahead of the autumn budget. Borrowing, the difference between public spending and tax income, was £18 billion in August, which was higher than analysts had expected. This figure reflects not only the structural weaknesses of the British economy, but also the mounting fiscal pressures Rachel Reeves must address. Despite an increase in tax and national insurance receipts, government spending surged even higher, driven by the rising costs of public services, benefits and debt interest. The latest borrowing figures for August is the highest for the month since the height of the COVID pandemic, when government spending was ramped up to support the economy. This warning is a reminder that the UK's public finances are once again walking a tightrope. Over the first 5 months of the financial year, borrowing has now reached £83.8 billion, a staggering £16.2 billion higher than the same period last year. Worse still, this figure already exceeds the OBR's March forecast of £72.4 billion for the entire period, highlighting just how quickly the government's fiscal headroom is evaporating. Rachel Reeves, the Chancellor, is now facing some of the toughest decisions of her career. She has set herself 2 strict fiscal rules, which she has described as non-negotiable and ironclad. 1. Not to borrow to fund day-to-day public spending by the end of this Parliament. 2. To get government debt falling as a share for national income by the end of the Parliament in 2029-2030. These rules are intended to reassure investors and the public that the UK remains fiscally responsible. But the reality is proving difficult. Reeves must now either raise taxes, cut spending, or find creative financial manoeuvres to stay within her own boundaries. Each option comes with political and economic risks. The speculation building around the autumn budget is intense. Analysts widely expect Reeves to introduce tax rises, though the scale and type of these measures remain uncertain. The decision is likely to hinge on the OBR's updated growth forecasts. Even small downgrades in productivity or growth projections can open up massive funding gaps, leaving Reeves with no choice but to find revenue elsewhere. The surge in borrowing cannot be pinned on one single factor. Instead, it reflects a combination of global and domestic pressures. In August 2025, the government's interest payments on debt jumped up nearly £2 billion compared with the same month last year, reaching £8.4 billion, largely because inflation drove up the cost of servicing inflation-linked bonds. At the same time, welfare costs rose by £1.1 billion to a total of £27.3 billion as inflation pushed benefits and pensions higher. Yet while spending is rising, the economy itself is barely growing. Businesses' investment has stalled, growth is flatlining, and as a result, tax revenues simply aren't keeping pace with the government's swelling commitments. Britain's long-term borrowing costs have hit the highest level in 27 years, fueled largely by global factors, but also investor worries over the strength of the UK economy and the public finances. The ONS said central government debate interest rose £8.4 billion in August, £1.9 billion higher than in the same month a year earlier. This reflects not just the impact of high global interest rates, but also lingering doubts about the UK's long-term fiscal credibility. The central problem Reeves faces is what many economists call the fiscal rules trap. By committing to strict fiscal rules, Reeves has limited her room for manoeuvre just as the economy requires flexibility. On one hand, sticking to the rules signals discipline and may reassure investors. On the other, it risks forcing damaging tax rises or spending cuts during an already fragile economic recovery. If Reeves breaks her own rules, she risks undermining her credibility and spooking financial markets. But if she sticks to them rigidly, she could stifle growth and place even greater strain on households and businesses. Her critics argue this isn't just a future risk, it's something they believe she has already done. They point to her 2024 budget when she raised employer national insurance contributions in an effort to stabilise the public finances. Business groups and opposition MPs branded the move a jobs tax, claiming it discouraged firms from hiring and contributed to rising unemployment and a reduction in job opportunities. For them, the warning signs are already visible. Reeves's insistence on strict fiscal discipline may be choking off the very growth the UK economy so badly needs. nor is cutting spending an easy alternative. Despite Labour's commanding majority, the government has struggled to deliver cuts when tested. The recent winter fuel allowance U-turn highlighted the difficulty of pushing through unpopular measures, while plans to reform personal independence payments triggered a significant backbench rebellion. Within the Labour Party itself, there is little appetite for austerity-style reductions. It's a classic policy dilemma with no easy answers. Either she bends the rules and risks her credibility, or she enforces them and risks further economic stagnation. Investors are already sending signals of concern. The rising gilt yields, which measure the cost of government borrowing, reflects a mix of global pressures and doubts about the UK's fiscal path. Higher yield means higher costs for the government, creating a vicious cycle. The more investors worry, the more expensive borrowing becomes. Currency markets are also watching closely. The pound has been volatile, reflecting uncertainty about the UK's economic direction. Any sign that Reeves might relax her fiscal rules could trigger further market jitters. So, what options does Reeves have? Reeves' choices are politically fraught. Here are some of the main options on the table. When it comes to options, Reeves doesn't have many. One path is tax rises. That could mean changes to capital gains tax, new wealth taxes, or adjustments to inheritance tax. They're all politically explosive, but they could bring in much needed revenue. Another option is spending cuts, but after years of austerity and with demand for public services rising, any move to cut back risks a major public backlash. She could instead focus on a growth strategy, investing in productivity and long-term reforms, but those kinds of measures take time to deliver results. And then there's borrowing more, what would ease the pressure in the short term, but it risks breaking her own fiscal rules and shaking investor confidence. Each choice carries risks for households, businesses, and the wider economy. Britain is facing a serious debt crisis, one that combines short-term borrowing pressures with long-term structural weaknesses. Reeves is caught between her own fiscal rules and the reality of rising debt costs, welfare spending, and stagnant growth. The autumn budget will be a defining moment not just for her, but for the UK's economic credibility. The figures speak for themselves. £18 billion borrowed in August, £83.8 billion in just 5 months, and debt interest at a 27-year high. Reeves must now decide whether to prioritise credibility with the markets or relief for households and public services. Either way, Britain's debt challenge is not going away anytime soon. The decisions made this autumn could shape the nation's economic